The beauty of Uber's model is that the vehicles are not on their balance sheet, and drivers can opt to make themselves available in response to demand in real time. Thus, Uber drivers can be incredibly flexible about responding to ride requests and a lack thereof. Another way to maybe say that is that supply on Uber's platform naturally adjusts to demand. And for, say, Waymo, to try and allocate XYZ number of cars to a city that will displace Uber, well, the reality is that they're either going to under allocate vehicles or over allocate them at any given moment in time. There's just no way to perfectly match demand with a fixed supply of vehicles driving around, which is why it's better to deploy a more limited fleet and just partner with Uber, tapping into their network for bookings. And then the vehicles can be used for other purposes or as just an occasional alternative to a regular Uber.
So, today's episode is on the mobility giant Uber, a company whose name is synonymous with its service, which is always a good thing, as we've seen with Airbnb and Google too. I've always questioned how Uber could make the economics of its business work. I felt either drivers, users, or shareholders would win at the expense of the other, and I struggle to see how they could balance all three interests. It seems very difficult to price rides cheaply enough so as to continue attracting riders while also charging enough to fairly compensate drivers in a sustainable way and still leaving enough meat on the bone for the corporation behind Uber to generate sizable profits from fees. Even as I say it now, I'm amazed that they have found a way to make it work. But they really have. And as we will explore in this episode, that core business only seems to be accelerating as the company expands into tangential areas too. But with that, let me introduce my co-host, Shawn O'Malley, who will be making the pitch for Uber today, and I will just be sharing feedback and questions along the way. And at the end, we will make a decision on whether to add Uber to our intrinsic value portfolio of stocks that we are building week in, week out on this show. Shawn, thanks for joining me.
Daniel, nice to see you again. We get into a nice rhythm here of breaking down a different company every week. And obviously this week is my turn to pitch something for you. So before we get started with Uber, I want to hit the elephant in the room, and that is autonomous vehicles. We're going to cover it more in detail today, I'm sure, but you're probably surprised to hear that, yes, I actually am not as concerned about that risk for Uber as you probably might think at first glance, which probably sounds crazy again, unless you've already studied ride-sharing companies closely. So don't make the same mistake I made of writing off this company because of distant fears around automation. That is sort of my message up front to the audience. And at least listen to the rest of this episode before you make up your mind on whether Uber is a good company to own.
I already brought up some of my questions and also past concerns, but today you are the expert on Uber. So where would you like to start?
I want to start at a high level here as we dip our toes into what is a very big company to understand. And to begin, Uber's got three businesses. There's, well, the business that most of us think of when we hear Uber, and the company calls that its mobility division. And then the second thing you might think of is Uber Eats, which the company calls its delivery division, since it's focused on delivering restaurant meals and groceries. And I'd say last but not least, but is actually the least in this case, that is Uber Freight. You might not even know Uber Freight exists. I didn't before I started researching Uber. This is a more niche, unprofitable business. It was founded in 2017. And the idea is similar to the other things that Uber does of connecting logistics. And that is specifically they connect truck drivers with shippers. So it's Uber for tractor trailers and businesses that have inventory to move around. And there you have it. That is, at a very high level, the three major categories of Uber's operations. I should also mention there are some sizable investments on its balance sheet as well from bets the company has made over the years that are valued at over $8.5 billion. So those are big stakes that we'd want to account for when we're thinking about the company's intrinsic value. And those stakes include other mobility and delivery companies like Didi, which you might call the Uber of China, and Grab, which is sort of the Uber of Southeast Asia, plus a company called Delivery Hero and the scooter company Lime, on top of some positions in self-driving car companies too. I think you could also say Uber is a bit of a conglomerate at this point, as I kind of just outlined with those different cross holdings. Yet across those cross holdings and their different business units, it's entirely focused on delivering things from point A to point B, whether that be people, food, or freight. Fundamentally, Uber is more of a variable cost company than a fixed cost company. And what I mean by that is that compared to, I don't know, maybe an airline company like Delta, which has mostly fixed costs in its fleet of aircraft, Uber doesn't have that many fixed costs like that. It doesn't own the vehicles its drivers operate, and there aren't any Uber factories. So it's a very capital light business in some ways. For the mobility division, at least, the primary costs are the drivers, the insurance that Uber provides for its drivers on their vehicles, at least in the US. We'll get into that, but they don't do that everywhere. And then the software development costs of the Uber app. But besides that, those are the three major contributors. And only the software R&D is anything remotely resembling a fixed cost. Otherwise, the number of Uber drivers and insurance costs are completely variable, scaling up with the business over time or down during recessions or like the pandemic. The good thing about that is that during an economic slowdown, Uber's costs naturally fall off. There are fewer people wanting rides, but also fewer drivers. So the variable costs fall off in line with revenues, and that helps insulate the business from huge losses. And you might contrast that with some of the hotel chains that were stuck paying for a bunch of real estate during lockdowns for COVID, and they couldn't monetize those assets at all, at least for a pretty extended period of time.
You've now mentioned the variable costs quite a lot of times, and they can cut both ways. While the asset-light business ensures safety in bad economic times, they also limit the potential for scaling up. Economies of scale occur when a company reduces its average cost per unit by increasing production or business volume. As the company scales, fixed costs are spread over a larger output, and operational efficiencies further drive down costs. This allows the company to improve profitability and gain a competitive advantage as it grows. For Uber, more rides mean more drivers, as you mentioned, so top-line growth is also accompanied by an increase in costs as well. What do you think about that?
That is the big issue of sorts with Uber. On the one hand, Uber has proven the world wrong in some ways by even becoming profitable at all, which is certainly due to some of the economies of scale that you just described occurring in its overhead costs and marketing. But at the same time, this isn't a company that's profitable in the same way that some other Silicon Valley tech giants are. Uber's economies of scale are more like Walmart's than Google, I'd say. The company's operating profit margin is only 6%, which is more than twice Walmart's for what it's worth, but still paltry compared to Alphabet's very chunky 33% operating margin. So it's not a perfect comp with Walmart because Walmart has a lot of fixed costs, which is why it's even less profitable. But the idea is that Uber doesn't have the incredible operating leverage of your typical software business since its operations are tied so closely to the physical world in terms of drivers and vehicle insurance. It's definitely not like Microsoft Office where each incremental Excel subscription basically comes with zero costs for Microsoft. For Uber to facilitate more rides, it needs more drivers. And in some ways, that puts a ceiling on how profitable its core business can be. But I'd also say at the same time, we're still in the process of discovering how profitable that core business can be. And 6% operating margins are probably on the lower end of what is achievable for Uber. So don't get me wrong, I'm sure their margins can go higher, but still, Uber will probably never have 30% operating margins unless they can cut out drivers completely with autonomous vehicles. But that is another discussion to go on.
But there's not only upside potential for margins, right? I mean, currently, Uber drivers are recognized as contractors, not as employees. And if that would change, how do you see that impact its margins?
It's an important point because we're talking about how Uber is not massively profitable at this point in time. And there's this lingering risk that cities, states, and entire countries could force the company to change how it treats its drivers, which would dramatically increase costs, as you sort of alluded to. Uber technically has 32,000 employees, but over 7 million drivers worldwide. And reclassifying a number of them to employees would just be very costly. So that risk has been swirling around for years, though, and has probably kept a lot of people from making a bunch of money by just having invested in Uber earlier. But it is similar to what I talked about with Airbnb a while back. Yes, you have these standalone instances of harsh regulatory action against the company, but all in all, governments have mostly been afraid to mess with a service that is so universally popular and so widely used. Uber is essential to how many people commute to work, how they get back and forth from the airport, and has arguably produced a ton of benefits for society by creating an easy way for people to get home after drinking. I'm sure Uber has probably saved thousands, if not millions, of lives over the last decade by simply preventing drunk driving accidents. So that doesn't explicitly go in how regulators treat them. I'm not arguing for that at all. But that does create some sort of societal value and goodwill that I'd contend at least helps them on the margins earn some leniency. I've seen some research that suggests as of 2019, after just a few years of operating at scale, Uber had already directly contributed to reducing total traffic-related fatalities by 6%, which is just really incredible and laudable. But the elephant in the room here again is California in this case, where Uber continues to try and prevent legislation that will require them to treat drivers as employees. And that's a big deal because, well, California is a huge economy and there are 1.4 million drivers in the state who do gig-related work for companies like Uber, DoorDash, and Instacart. California voters put a measure called Prop 22 on the ballot, which basically exempts Uber from classifying drivers as employees. And that was approved in a popular vote. And the California Supreme Court ruled to uphold Prop 22 last year. So that was a major victory for Uber. The long and short of it, without getting into all the legal weeds of it, is that despite challenges, Uber gets to keep operating business as usual there. And that's not expected to change anytime soon. And unless the United States Supreme Court interprets related cases with a dramatically different ruling, which would be very unexpected, then as far as I see it, the matter has pretty much entirely been resolved in Uber's favor for the foreseeable future. There are definitely places like the UK and the Netherlands that have added extra labor protections for Uber drivers, but nothing that has been terribly consequential for Uber's business model globally.
Well, from a German perspective, Uber had quite some trouble here. And for many years, it wasn't allowed at all. And even now, it's totally different from the US version of Uber. Uber can only work with licensed taxi and so-called private vehicle operators. So basically, that means that all the drivers must have a special license. And that means that you're not actually driving with a private person when you have an Uber. In most cases, your driver is employed with a subcontractor. And as far as I know, those drivers usually use multiple apps, so Uber, Bolt, or FreeNow. It's basically just an easier way to order a taxi. But getting back to the US business and regulation over there, what has been happening with Uber in New York City? I think legislation there seems to be more focused on ensuring minimum hourly compensation than making drivers into employees. Is that right?
For context, drivers are paid per mile and per minute, though some states and cities like New York have tried to force Uber to basically guarantee a minimum profit per hour. To some controversy, Uber tried to get around that with these rolling blackouts that prevented drivers from consistently accessing the platform during times when there were too many drivers online, so when there was excess supply. And the reason for that is because the calculator for what drivers would need to earn per hour revolved around utilization rates, where if drivers are constantly busy, their pay mostly comes from user fares. But if drivers have a lot of idle time before being hailed, the utilization rate declines and Uber may have to compensate them out of its own pocket. So that's why they used lockouts during periods of low demand, making it impossible for some Uber drivers to technically be working on the clock, which artificially reduced the supply of drivers and made other drivers busy enough to not meet minimum pay requirements. Uber has claimed that this program incentivizes people to sign up for Uber and just drive around to collect a minimum payment without accepting rides, which is why they're so averse to the program. And take that with a grain of salt, but it's at least plausible in theory. Some legislators are also trying to pass laws to force Uber to disclose its take rate and prices charged for customers on each ride so drivers can decide whether they're getting a fair cut. Though that could reveal sensitive data to competitors and also poses risks to Uber's ability to sustain its take rate if everybody knows very transparently what it's charging. And anecdotally, I've heard that Uber drivers accept rides and don't necessarily know how much they'll make from them beforehand, which seems kind of crazy. Nor do they know how much Uber charges for the ride overall, which again seems ripe for some exploitation and has contributed to Uber's image, which has really soured over the years. And I do see that as being a meaningful risk for the business. From internal scandals over sexual harassment to a lack of transparency with drivers and a bunch of other stuff, Uber's reputation has just been dragged through the gutter and is pretty severely tarnished at this point.
Well, there are companies where I would say they have a better reputation than Uber. That's true. You mentioned how Uber's variable costs include vehicle insurance. And in the years after the pandemic, the average cost of auto insurance rates increased by about 13%. And even after temporarily coming down again, it soared another 20% in 2023. The reasons were supply chain disruptions and labor shortages that increased car prices and repair prices, which in turn led to insurers to raise the premiums. Could you provide us with some information on how substantial these costs are and how much the surge in auto insurance rates after the pandemic has affected Uber's business?
It's funny because Uber is basically the opposite of every platform company I've ever studied. With Airbnb, Reddit, and Spotify, their businesses are considerably more profitable in the US than elsewhere because Americans have high incomes by global standards and because there's just such a robust set of advertisers interested in monetizing American customers. Since, again, it's a major economy that's also very unified as opposed to Europe, where you have rich nations, but the markets are completely fragmented. France is a vastly different place than Portugal, and each have their own languages, cultures, and regulations. So it's just much easier to advertise at scale across the US than it is to do so in Europe. And as a result, subscribers and users from the US are typically worth a considerable premium in some cases compared to Europe, and especially compared to other parts of the world. And the thesis for these companies usually premises around users from the rest of the world converging on ARPU rates in the US, which stands for average revenue per user. But with Uber, it's actually more profitable outside of the US than it is in the US, mostly due to the vehicle insurance I've mentioned that it's required to provide to US drivers. In places like Mexico or Brazil, the average vehicle is worth considerably less than in North America, which means that the insurance costs are naturally going to be less, and drivers are also willing to work for less per ride. So it ends up being comparatively quite cost effective to operate at scale in emerging markets and other low cost areas. Again, that's just really uncommon. And yes, they do earn less per ride in these places, but it still ends up netting out such that Uber's international operations are more profitable than its US business generally, which is counterintuitive when we think of Uber as sort of an American company in many ways. That puts Uber in the unique position of scaling globally and actually becoming more profitable outside of its core market. In the US, auto insurance has increased by several times more than inflation since 2021. And in part, that's because vehicle shortages have made new and used cars way more expensive, which correspondingly makes vehicle insurance more expensive. Fortunately, Uber is expecting this to normalize pretty dramatically in 2025, but yes, this has been a real pain point for the company. Drivers have to have their own vehicle insurance when offline for context, but whenever driving for Uber, Uber provides them with extensive collision and injury insurance. And Uber does apparently charge some fees to try and offset that, but there's just no getting around the fact that this is a major cost of doing business for them that is hard to hedge against as well. Uber has roughly 30% gross profit margins, meaning their costs of revenue are 70 cents on every dollar earned. And a big chunk of that goes straight to insurance, in addition to the compensation to drivers and bonus incentives they're paid, credit card processing fees, and some platform maintenance costs. Also, because of all this, Uber has set aside billions of dollars in an insurance reserve fund, which is a liability on its balance sheet, reflecting that there's this ongoing risk that it may have to make larger than expected insurance payouts down the road at some point.
we've talked about the headwinds from insurance and driver costs now. And considering that, how is the mobility business generally doing? And specifically, since you mentioned lower insurance costs and driver costs overseas, how is the business doing over there?
Uber's core business is by all measures booming. It's doing great and growing quickly. And in large part, that's due to its adoption overseas. Uber thinks its core business can grow in the low to mid teens through 2026. So the runway for growth remains long and has been that way for years now. Management has actually said that they're genuinely surprised at how steadily the mobility business has been able to grow. And when you look at the numbers, I am too. In the last year, gross bookings are up 20% year over year. And that growth really stems from a simple formula, or at least a seemingly simple formula. And that is, in new areas and cities, Uber tries to build out supply first, ensuring there are enough drivers. And then they try to stimulate demand with marketing and promotions for discounted rides until riding becomes something of an entrenched behavior and habit for people. That really hurts margins in the short term, but it does buy them some lasting advantages once they reach scale and can tap into network effects. And that ties into how I think about Uber at a high level. Uber is simply a marketplace connecting riders and drivers. And Uber sees it as that customers either pay with time or with money. You can pay more money for a ride exactly when you want it, or you can pay with your time as you wait for a more affordable Uber option or for a lower price quote as peak demand normalizes. That is all what makes Uber a marketplace, but rider preferences for paying with time or money aren't going to be the same everywhere. In the suburbs, for example, management says that they found riders are more open to pay with their time, which is bad for Uber because they're accepting longer wait times. And I think that makes sense for them to do that because you'd imagine that correspondingly, the average ride price is lower here because there's just less demand. And people might be more willing to wait for peak periods of demand to pass. Whereas if you're stuck downtown after a concert, you'll probably pay maybe a massive premium to get home at that exact moment. And that kind of underscores generally why the suburbs have been a tougher market for Uber to operate in, at least compared to the runaway success they found in a lot of cities. Costs of vehicle ownership are lower in the suburbs, so more people own cars, which makes Uber a lot less essential and dampens the network effects it has working in its favor.
It's funny because I never thought about that. Yeah, but it makes a ton of sense because when I do order an Uber, it's when I'm in the city and maybe the bus or the subway is canceled and I just want to get home. And then I don't care too much about paying a $4 or $5 premium. And I guess if you're used to living in the suburbs, you're also used to longer waiting times for public transport and probably have more patience with waiting for a cheaper Uber. So maybe talk more about prices. I've read that Uber regularly tries to undercut Lyft on pricing. Is that true? And what are the implications for Uber's long-term profitability?
Hey guys, this is your host, Shawn O'Malley. When I first started learning about stock investing, I had no idea what direction to go in. There's just so much to try and wrap your head around, but it's never too late to get smarter about stock investing from the ground up. After spending years interviewing and studying from the world's best stock investors as a company, we've distilled those learnings into a simple course for you. Why? So we can help you master the principles of excellent lifelong stock investing. The course is great for both beginners and pros. From studying what the legends actually do to small, practical ways you can build wealth more effectively over a lifetime. We'll take you through different sections covering the basics of what a stock actually is and how stock markets work, to strategies to optimize your retirement savings, picking great companies, what to look for in ETFs, how much you should invest, and how to monitor your investments, plus so much more. By the time you're done, you'll be ready to invest in the stock market, learning plenty of tricks from the pros along the way. To access the course and begin learning how to invest like the legends, just visit theinvestorspodcast.com/get-started-with-stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. That's STOCKS15 when checking out. Want to land a job in investment banking or private equity, but feel like you're stuck on the outside looking in? That's where CFI, the Corporate Finance Institute, comes in. CFI is the #1 rated online finance and banking training provider, chosen by over 2 million professionals worldwide. CFI's courses equip you with the same skills top analysts and associates use at leading firms. I really appreciate that you can study at your own pace and have the chance to solve real-world problems with case studies. It gets even better though. Right now you can get 30% off any Corporate Finance Institute plan. Take the first step toward your dream job. Head to corporatefinanceinstitute.com, enroll today, and use code INVESTORS30 at checkout for 30% off. Look, I'm the type of person who is always trying to find new ways to make a little extra money. In this economy, that's just what you have to do. But not every side hustle is equally simple. Fortunately, using your house as an Airbnb is easier than ever, now that Airbnb has made it possible to have a co-host do all the hosting for you. You provide the space, get paid, they handle everything else. With Airbnb's co-host network, you can seamlessly hire a sophisticated co-host in your area to take care of your home and guests. I have a good friend who owns his home, but he's looking into law school, meaning he might have to move somewhere else for a few years to do so. Unless he wants to sell his house, his home would just be a liability that costs him money while he's not even there to use it. He would be the perfect candidate for working with a co-host through Airbnb to help him make some extra income from his place without all the stress. If you have a second home, travel often, or are away for extended periods of time, go find a co-host at airbnb.com/host and start earning extra money today. I think we all know that Lyft is Uber's biggest competitor in the US. And as Buffett and Munger have said before, all it takes is one tough competitor to kill a great business. And yes, you're right. Uber does try to undercut Lyft pretty frequently on pricing. It's sort of an open secret in the industry that they do this. Immediately, you might think, uh-oh, is this a race to the bottom? And if so, that's never good for shareholders and the companies that are racing to the bottom to try to get scale at all costs. I see it differently with Uber, though. Uber does undercut Lyft, yes, but it's from a position of strength in some ways. For starters, Uber has the scale and data to more comfortably lower prices. And with that, by undercutting Lyft constantly, they can actually freeze Lyft's ability to grow its market share. Everything else being equal, you probably think Lyft should be growing faster than Uber as a smaller company, but this is mostly a winner-take-all industry due to the network effects involved. And so despite being a more mature company than Lyft, Uber is still growing faster. And as a result, Uber's market share is only increasing. And for the most part, it's hard for Lyft to really seriously compete. Honestly, the outlook is only worsening for Lyft, in my opinion, because as Uber scales, its service becomes more convenient with lower and lower wait times, and that increases the service's value to users and thus the company's intrinsic value too. There's a self-reinforcing feedback loop here working in Uber's favor, which is why I see Lyft as being almost a secondary competitor. No one seriously thinks Lyft can beat Uber, and not many even think Lyft can dramatically increase its market share either. My feeling is that Lyft will probably always be relegated to being the backup plan in case you can't get an Uber booked, and maybe that's an okay business to have, but it's certainly not as good as Uber's.
I mean, it makes sense since the whole idea of getting an Uber is convenience. And once Uber has a network where it only takes a couple of minutes to get one, there's pretty much nothing that Lyft could offer to take market share away from Uber. And it's similar to social media apps, for example. I mean, even if you would build a better Instagram today, the power of Instagram is its user base. I'm on there because my friends are on there, right? And the power of Uber is its vast network. If it takes less time than getting a Lyft, I will always call an Uber. So if time is convenience and convenience is what Uber is selling, then they will always have the number one spot. And it's very hard to take that away from them. But before we fall into the trap of only looking at it from a Western lens, what about other parts of the world? How does competition look on a more global scale?
Lyft is, broadly speaking, the second biggest competitor in ride hailing, though, as I was saying, that doesn't make it the toughest competitor for Uber. Different markets have their own ride-hailing services, and those regional competitors may be more entrenched than Uber or Lyft. So that creates challenges when trying to scale Uber into every possible area to have the maximum global network effect achievable. Lyft has around 8% of global market share in ride-hailing, but 24% of that is in the US. And it's pretty much entirely concentrated in the US, and we already know that Uber towers over them there. Whereas with Grab, which is basically the Uber of Southeast Asia, Uber did try to compete with them, but exited when they realized they couldn't make up ground against a company that had a head start, and for all intents and purposes was using their own playbook against them there. Uber pretty quickly recognized that it was at a disadvantage and sold its operations to Grab in Southeast Asia in exchange for a 27.5% stake in the company. And that has since been diluted down a bit, but I actually really like this strategy overall. It's very pragmatic. If you can't beat them, join them, right? As they say. And ideally, I'd want Uber to dominate the entire world. But if that's not possible, then it's a very reasonable allocation of capital to look at where you can't win, accept that reality, and invest in who will be the winner of that market so you can still benefit. Grab IPO'd on the NASDAQ in late 2021, actually, and it's an interesting company in its own ways. I'm not as excited about it, though, because just structurally, the company hasn't proven it can earn a profit yet. And that may be due to the reality that it's more difficult for them to reach the kind of scale outside of Southeast Asia that Uber already has, and that has enabled it to be profitable. Just to take a step back and look at ride sharing globally, you've got Uber and Lyft as a duopoly in the US, and then in Latin America, Uber is the market leader again, but there's competition from Chinese companies like Didi. And then in Europe, as you alluded to, Daniel, there's a handful of competitors that you might know, like companies like Bolt, which is from Estonia, Free Now, and then there's a Russian company, Yandex, that Uber used to own a piece of.
You know, when I think of Bolt, the first thing that comes to my mind is their scooters. Their scooters are everywhere, and people my age, they use them for almost every trip they need. Like if they go to the gym, they will take a scooter. If they need to shop for groceries, they will take a scooter as well. If you need a car, most people that I personally know use Miles, and Miles is an app where you can quickly rent a car for yourself. And then the app shows you a car close by, you can drive to wherever you want, and then the car is free again. But that's not the idea of Uber. So if you need a car and you cannot drive yourself, for example, after a night out, I think you mentioned that as well, Uber is still the biggest player in Germany, and I think in most of Europe as well. Despite other options like Bolt or Free Now, I think generally you could say that the European market, also because of the regulation, is just a lot more fragmented than the US market, because the whole idea of Uber there is totally different.
Hmm. The picture is definitely messy in Europe, and I appreciate you painting some color around it. From a market share perspective, Uber is actually the leader there, at least across Europe generally, but its lead just doesn't feel as rock solid as it is in other places. And going back to Yandex quickly, that Russian Uber I mentioned, Uber had partnered with them in 2017 through a joint venture, but that has, for obvious reasons, become increasingly problematic. And now Uber has exited Russia entirely. So that market is basically just a lost cause for them. And this goes back to the point that a number of companies saw what Uber was doing in the US and recreated it in their countries before Uber could expand there, which is how you get all these arrangements where Uber is instead investing directly in some of these regional winners or doing joint ventures with them. Again, Uber has found a number of interesting ways to get around this problem. And in the Middle East, for example, that meant acquiring a company called Careem. Through Careem, Uber now dominates the UAE, Saudi Arabia, and Egypt. And then turning back to Asia, Uber did the same with Didi in China as it did Grab. They exited China, ceding the country to local competitors while taking a 17.5% stake in Didi. And maybe now you can see why I mentioned Uber's cross holdings as being so important earlier, as really necessary to understand the value of not only the company's intrinsic value, but also in a way their operating strategy around the world.
It speaks for Uber's management, though, not to fight in a battle that would cost a lot of money and is probably lost anyway. And additionally, you have significant stakes in the regional champions, and those are investments that could compound over time and then again add to Uber's intrinsic value, especially since Uber can not only provide money or funding, they can also help improve the operations with all the expertise they have, right? Still, there's also a risk of exiting markets and then backing the wrong horse with their investments in the region. So how successful have Uber's investments been up to this point, and how do you see that strategy long term?
The playbook of investing in competitors has worked better in some places than others, you're right. Like in China, Uber couldn't compete there, so owning part of Didi made a ton of sense. Yet now, as sentiment on Chinese markets has soured in the last few years, that investment in Didi is worth a fraction of what it once was. Uber says their stake in Didi is still worth $2.6 billion, but that's down from the roughly $6 billion valuation their investment had when they first sold their operations off to Didi. So I don't want to make it seem like Uber has benefited massively from exiting markets and investing in local competitors instead. That bet on Didi hasn't created any long-term value for them and came with opportunity costs of losing out on the Chinese market over time. And last but not least, the only other major market we haven't really talked about is India, where Uber is the second largest market share behind a company called Ola. With the exception of China, Russia, and Southeast Asia, Uber is either the market leader or at least a major player in just about every sizable country globally. So I do think it's promising as they continue to leverage their scale and financial firepower to expand in different ways around the world. I should also mention that even though Uber's mobility business has a global presence, it's very concentrated in just 5 cities. LA, Chicago, New York, London, and Sao Paulo, Brazil made up 20% of all of their gross bookings for Uber rides last year. And if any of those cities have dramatic changes in regulation or competitors that become particularly aggressive about running promotions there, it could have serious consequences for Uber's results. I was pretty surprised when I saw this mentioned in Uber's 2025 annual filing. It's just a totally different structure than our portfolio company, Airbnb, which is a similar company in some ways and also faces lots of regulatory and competitive risks, yet no city makes up more than 2% of its revenues, which is just a totally different picture.
It is really surprising that a company as global as Uber is so concentrated in just 5 cities. I mean, we're not even talking about countries, but cities. Of course, this adds a layer of risk, especially with all the regulatory background that you mentioned in some of those cities. And we've already discussed New York, for example. But despite their focus on diversifying globally, Uber is also diversifying in terms of business segments. What are the ways in which Uber can continue to grow its business beyond their main business that we all know of?
What's been really interesting to me about studying Uber is learning about all the different ventures tied to their mobility division. They've got a program called Member One, which offers $0 fees on food and grocery delivery, 6% back in the form of credits on rides, and discounts on certain orders. And then there's Uber for Teens, which is a program that's live in 50 countries now and enables teens to create their own riding profile to order Ubers through, while their parents can track their exact location when riding at all times. And then there's Uber Black, which is sort of for corporate travelers seeking luxury vehicles and first-class services, as well as Uber Courier, which is a service that allows users to send and receive packages using the Uber app. So drivers can actually use Courier as a way to earn extra money by delivering packages while completing Uber rides. And then in Japan, Uber's been partnering with taxi businesses there that has brought on an additional 20,000 vehicles to the platform. And then on top of all of that, there's Uber Health, which I think is a brilliant service for non-urgent medical travel where Uber partners with a number of various medical institutions for this. So maybe you need someone to pick you up after a surgery or something like colonoscopy. Folks could rely on special Ubers to arrange timely transport for these very important things that are maybe not life-threatening. So I'd imagine this is especially helpful for people who live alone and for the elderly. And again, it just makes a ton of sense for how Uber can create value here. And it's a great way to continue making their ride-sharing service even more accessible on the margins. There's also always the opportunity to run more ads, which is another subtle advantage of Uber's scale. They're big enough now that advertisers want to work with them to show ads in drivers' cars. And it's a win-win because drivers can earn a little extra money by setting up screens to show ads to their riders. And if you haven't seen it, these are usually in the back seats of cars, and it embodies the old expression that ultimately every company is an advertising business, at least for ones that rely on network effects like Uber. It's actually a much more powerful idea too, I should say, than it first sounds, because Uber has so much data on where people are going. You can imagine that advertisers may want to run location-based ads through them. So it's not entirely just billboard ads flashing on some screen in the back of an Uber. If you're Ubering to a basketball game, A nearby bar might want to target you with ads while you ride in your Uber to the venue. Or if you're Ubering to work, some local restaurant may want to hit you with an ad that plants a seed in your mind for what you'll have for lunch for that day. And my baseline view is that having demographic data on people and knowing exactly where they're going in a moment in time is just really, really valuable, especially when you have their captive attention as they sit in the back of a car. And we haven't even gotten to Uber Eats yet, but advertising is also a very big part of the story there, especially for in-app ads.
I just realized how different my experience with Uber is compared to the US experience and personally your personal one. I've never seen an Uber with ads in the background or anything like that. And services like Uber Health could definitely become a much bigger thing in the future. And the ads business, even in the short term, I mean, if you have high quality data like that, there's definitely the option for many companies to use that to leverage their business. But let's turn to Uber Eats now. This isn't just about the future because it's big already. So tell us, how big exactly and what part does it play in Uber's ecosystem?
Yeah, let's do it. Let's talk about Uber Eats. Just to give some stats on how big this business has gotten. There are now over 1 million active merchants selling through Uber, up 16% from last year. And sales per merchant are increasing on average too. And even more promising is the potential for further penetration. In Uber's 10 most penetrated delivery markets, they have about a third of available merchants listing their products. So there's room to grow considerably. If they can even get half of all merchants in an area to list their products on Uber Eats, which is ambitious but not totally crazy, especially as the network effect around Uber Eats strengthens. And the quality of the service is just getting better too. Defect rates, for example, are declining, meaning more orders are being delivered accurately through Uber Eats, which only increases the value proposition of the service if you have more trust that you're going to get exactly what you asked for, right? If you have more confidence that your order from the local Mexican restaurant won't be messed up, you're probably more inclined to use Uber Eats. So Uber is finding ways to improve their quality control. And again, I just see that as being very promising. Then to go back to the conversation about ads, merchants can run ads on Uber Eats to drive sales based on certain searches. So as an example, you might search for Mexican food in your town, and the first result could be a sponsored listing from Chipotle. Beyond the fact that that is just a powerful tool to improve the business's monetization, I think it also strengthens the network effect around Uber Eats amongst merchants. If the restaurant across the street from you is not only earning extra sales from working with Uber Eats, but also runs aggressive ads that pull business away from your restaurant, all of a sudden you're compelled to join Uber Eats and maybe even run your own competing ads there to offset that. And if that thinking is even partially true, it's a really effective way to increase the supply of merchants on Uber Eats, which adds more options for customers and again makes the service even more useful and valuable. And it just compounds upon itself. I'll just say that generally I've been so impressed with what Uber has been able to do with ads. It's not an easy thing to start up from scratch, and yet they've turned ads into $1 billion business in a very short period of time.
The more you say about the ads, the more I would like to dig deeper into that business. But staying with Uber Eats for just a second, while the main business is about delivering restaurant food, they also introduced grocery delivery. What's the idea behind that? Is it a better business to be in, or is it just another way to expand the offering?
Restaurant takeout and delivery are the bread and butter, but grocery shopping is sort of the golden goose a lot of these companies are all after. On paper, it's just a better business intuitively because grocery shopping is a required habit for everyone, and therefore the TAM is probably wider. And also it's a recurring habit. People shop for groceries at least once a week, probably. And if you can get people in the habit of using your service to order groceries weekly for delivery, then that's a really sticky and stable business. You don't need me to spell that out for you. And it is much more so than getting people to use Uber Eats whenever they might randomly decide they don't feel like cooking on sort of an impulse. Instacart is, of course, the big leader here. And as Instacart tries to expand its reach, they've partnered with Uber Eats such that Uber Eats is now integrated into Instacart, meaning Instacart users can order restaurant delivery through Uber Eats in the Instacart app. That was a lot to say, but hopefully you followed along with it. And it's interesting to me that this dynamic doesn't go both ways. There is no Instacart integration in the Uber Eats app. And instead, actually, Uber directly competes with them by offering grocery delivery services in its own app. So that imbalance there sort of signals to me as an investor that Uber has the power in the relationship here. And as part of that partnership, Instacart has this membership service called Instacart Plus that charges $100 per year for unlimited free grocery delivery for orders over $10, as well as restaurant delivery through Uber Eats with free delivery on orders over $35, I think.
Well, to me, that sounds like Uber is in a good position to take market share there. But I'm asking myself, how sustainable is that? In Europe, online grocery shopping is not that big of a thing yet. I think that's different in the US, but how optimistic are you that Uber can not only take market share from Instacart, but also defend that position against the big retailers who seem to do similar things?
The tricky thing about grocery delivery, going back to that conversation, is that intermediaries like Uber and Instacart are much likelier to get cut out of the equation than with Uber and self-driving vehicles. So Walmart, which makes up more than a third of all online grocery sales in the US, and Target, as well as Amazon with Whole Foods, have shown how grocers can push out third parties by building their own delivery apps and fulfillment centers, especially for home delivery or pickup, which rely heavily on automation and AI. More than 4,000 Walmart stores offer same-day delivery, and the costs are offset by digital advertising for online ordering and through membership costs for Walmart Plus. So again, you just have this strong incentive for grocers to eventually remove middlemen and take over these operations themselves, assuming they can afford to do so. And that gives me some pause and suggests that eventually third-party grocery delivery services can only work with smaller regional grocers because the larger chains with more resources will build out their own delivery systems. We've already seen that unfold. So I'm definitely not as optimistic about the grocery side of Uber Eats, but I also don't see the same risk in its core restaurant delivery business. The vast majority of restaurants are these independent operators who don't have the resources to manage an app for ordering and also be able to deliver the food to customers in a timely manner. It's just too costly and way, way beyond their core competence. So, of course, it makes more sense to just tap into Uber's network and the capabilities that Uber Eats offers for them. And Uber is experimenting with some cool stuff here, too. Reportedly, they're working on autonomous delivery robots for groceries, and I've actually seen this kind of thing in action myself on college campuses, and it works well. My parents live near a college campus, and whenever you ride through it, you see all these robot couriers on the sidewalks, and they're almost like little R2-D2s out there for any Star Wars fans. And basically, they're box-looking robots that get loaded up with food, navigate to dorms, and then deliver everything. And I'm skeptical of how you could do that elsewhere, but it does work particularly well in these insulated, walkable college campuses and maybe certain cities in the US. But besides that, the distances they need to travel start to complicate things, and you can imagine there's some real traffic hazard situations that could arise. And maybe you use drones for certain deliveries, which I know Alphabet is working on, but I'm not sold on it yet. I think self-driving Ubers will hit scale much faster than autonomous food delivery. Just personally, I can see myself hopping in a Waymo that I ordered through Uber way sooner than I'd pay to have my groceries delivered by a robot. I also live close to a couple grocery stores, so I'm probably biased, but I mainly use Uber for rides. And I don't pay for grocery delivery because I'm one of those people who likes to wander the store and pick out exactly what they want. And I don't want somebody else touching my fruit, for example.
Well, same here. I mean, I like to go for walks, and the walk to the grocery store is just something that I like to do. So I don't want a robot to take that away from me. But we've talked about Uber Eats for quite a while now. And you haven't even yet mentioned DoorDash. Isn't DoorDash the market leader by a pretty wide margin? And how is the dynamic there? Could Uber Eats take the number one spot? Or are there competitive advantages working in favor of DoorDash that are just too hard to crack down for Uber?
It's definitely an oversight on my part. Uber Eats is to food delivery as Lyft is to ride hailing in the US. I think it's destined to be the second biggest player in food delivery since DoorDash has roughly 2/3 of the market share. DoorDash has clearly been the winner so far. Food delivery is their core service, so it's not a huge surprise that they're the best at it. And all of their attention goes to it naturally, whereas Uber is trying to do a bunch of different things, which just makes it hard to compete well on any individual measure. And by some measures, DoorDash's customer retention rate is twice that of Uber Eats. So it's hard for me to simultaneously argue that the odds are stacked against Lyft in ride hailing and then pretend the same isn't true for Uber Eats versus DoorDash. I think it can be a solid and maybe growing business, but I don't see any plausible pathway for them to seriously grow their market share in the US, which is certainly not their only market though. My feeling is that Uber is more focused on using Uber Eats as a way to strengthen membership packages that extend across its various platforms, whereas DoorDash is truly trying to dominate the food delivery market at all costs. So in part, they're just coming at it from different perspectives. I don't think Uber Eats has the same goals, at least not in the US. We mentioned those Uber One memberships already, but it's a compelling subscription service because it offers both savings on rides and food delivery. And in some ways, beyond being a decent business in its own right, you might say Uber Eats really exists so Uber can leverage it to cross-sell various membership packages. And we see the same thing with Amazon. They have all of these peripheral businesses that really only exist to be part of an Amazon Prime membership package. The reality, though, is that they're not just competing with DoorDash. They're also competing with Amazon, who I just mentioned, which is intimidating. There's this quote from Uber's CEO where he says that, while Amazon is the global leader in e-commerce, he believes Uber can be the global leader in local commerce. So maybe their plans with Uber Eats are more ambitious than I give them credit for.
Subscriptions seem to be a recurring theme with our companies. You mentioned it for Amazon. I mentioned it a couple of weeks ago with Nintendo. But it's just because there are few better business models than subscription services. So it's not surprising Uber would try to expand their offering to upsell those memberships. But judging by the CEO's comments about the global local commerce leader, we might underestimate the vision they have for their business. And on that note, is there anything else we should know about Uber's delivery business unit?
One last thing I'd mention is Uber Eats Direct. We already talked about how some grocers are trying to cut out middlemen for ordering delivery, and how this is also harder to do for restaurants. But Uber is still trying to get ahead of the innovator's dilemma here, which, just for the audience, is this famous dilemma where the incumbent leaders in a market aren't incentivized to disrupt their most profitable business, yet there are competitors on the horizons experimenting and building alternatives that may eventually displace them one day. And all you have to think about is Google search with encyclopedias. And Uber is addressing this with restaurants by offering Uber Eats Direct, which is a way for them to integrate their point of sale systems with Uber's API. And that's kind of technical jargon, but instead of just listing their restaurant on Uber Eats, restaurants can actually embed the ability to do delivery orders through Uber Eats directly into their own websites and apps. So they can work with Uber Eats, but they can do it through their own website. And I'm sure these places still list on Uber Eats as well, but they just get a lot of traffic from their own websites still. So it just makes a lot of sense for them to add that capability directly on there. It's a really smart idea in summary, and a great example of the kinds of things Uber can do as a tech company. And I think it addresses the innovator's dilemma to some extent because it just makes it even more compelling for restaurants to work with Uber. It makes them more dependent on Uber, which probably reduces the risks of disruption for them going forward.
In investing, there has been this trend for cloning big investors. On that note, just recently, Bill Ackman has very publicly, on X to be precise, announced a $2 billion investment in Uber. What do you think about that? And if Bill Ackman invests, is it bullish or is it bearish for the stock?
I love the way you phrase it. Ackman has such a mixed reputation these days, and I am certainly no Ackman chaser following him into stocks. But I did make a point of trying to understand what was making him bullish on Uber, because with somebody of the pedigree and track record he has invested in a company, it's worth your time to understand why. And he cites a few things in his presentation to his Pershing Square shareholders after they took a $2 billion plus stake in Uber. And that did send Uber stock up 7% immediately because, a lot of people are going to follow someone of his profile into a trade. And he claims that he thinks autonomous vehicles are actually a more than $1 trillion opportunity that can entirely reshape Uber's business for the better. And on Twitter, Ackman wrote of his bet that, quote, "We believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased at a massive discount to its intrinsic value. This favorable combination of attributes is rare, particularly for a large cap company." And so Ackman's bull case on Uber isn't incredibly unique or anything, but it boils down to believing that the company's 20% take rate, which is the fee they charge on bookings, is low relative to the value they create, and that Uber's valuation is cheap in price to earnings ratio terms, given the company's growth history and management's expectations about growing in the future. And I'd guess that the reason Uber is priced more cheaply than it otherwise would be given the quality of its business is because of this massive cloud of uncertainty hanging over the company with autonomous vehicles. But again, Ackman and Uber's management teams really differ with the market and say they don't see that as a major risk. And if anything, they see a significant opportunity. And the idea, in short, is that while companies like Waymo could theoretically cut Uber out as a middleman for connecting riders with self-driving vehicles, that ends up being much easier said than done. For example, attempting to replicate Uber's capabilities as opposed to partnering together is almost economically irrational, given that Uber has aggregated 170 million customers together and has the most advanced rider matching technology, which helps to significantly boost utilization rates and revenues and all that good stuff. And at the heart of this is really that it's very inefficient for an autonomous vehicle company to also try and do what Uber does. Demand for rides is not constant throughout the day. There are peak periods at the beginning and end of the day, and then dramatic fall-offs in demand. So if you build a fleet of autonomous vehicles that are trying to cut out Uber, they're going to be sitting idly most of the time and not be fully optimized.
Without being too knowledgeable about Waymo's technology, it does seem like the partnership between Waymo and Uber seems to be a win-win situation. If Waymo would try to cut out Uber, it's probably hurting both companies. Uber has more competition, and Waymo carries the costs of a massive and inefficiently managed fleet of vehicles. Just like Uber decided not to participate in expensive market share wars with international ride-sharing companies, it seems like Waymo's best move would be to do the same here and instead just partner with Uber to get the best of both worlds.
The beauty of Uber's model is that the vehicles are not on their balance sheet, and drivers can opt to make themselves available in response to demand in real time. Thus, Uber drivers can be incredibly flexible about responding to ride requests and a lack thereof. Another way to maybe say that is that supply on Uber's platform naturally adjusts to demand. And for, say, Waymo, to try and allocate XYZ number of cars to a city that will displace Uber, well, the reality is that they're either going to under-allocate vehicles or over-allocate them at any given moment in time. There's just no way to perfectly match demand with a fixed supply of vehicles driving around, which is why it's better to deploy a more limited fleet and just partner with Uber, tapping into their network for bookings, and then the vehicles can be used for other purposes or as just an occasional alternative to a regular Uber. But it's hard to see how they could cut out Uber entirely without massively misallocating resources. And we are already seeing early illustrations that autonomous vehicle companies understand it's in their best interest to partner with Uber, given the infrastructure it has in place around customer service, insurance, and the network effects of having so many people who already use its app. Uber has 14 autonomous vehicle partners, including Waymo, across its mobility, delivery, and freight divisions. And according to Ackman, at least, that is likely to expand over time. And on top of that, 50% of the bookings on Uber are for delivery, which, given the human element involved in picking up and delivering food, means that Uber Eats is almost certain not to be adversely affected by autonomous vehicles anytime soon. And additionally, Uber is further insulated because more than 50% of their mobility business bookings are from outside the US. And autonomous vehicle adoption is going to be much slower in less developed markets like Brazil and India, or in places like Europe that are likely to have more stringent regulations on implementation. So they have some natural buffers in their business, and the chance to truly partner with companies like Waymo. And if you take that at face value, then you can certainly see why Ackman is bullish and why he thinks the market is overly concerned about Uber's business being fundamentally disrupted by autonomous vehicles.
You mentioned that Uber already partnered with autonomous vehicle companies like Waymo, but also a dozen others. Could you paint a little more color on how exactly those partnerships look like and what management has said about the outlook going forward for AVs? It seems like Bill Ackman is pretty bullish on that.
The early results of partnerships like the one with Waymo are really promising. In earnings calls, Uber CEO has emphasized that the company is very, very well positioned for autonomous vehicles. Apparently, the opt-in rates for Uber rides through Waymo is considerably higher on the second ride than the first ride, showing that people are at first hesitant, naturally, to ride in a self-driving car, and then they love the product very quickly. So much so that Uber's management believes Waymo rides can be priced as a premium product, which is how we get back to talking about autonomous vehicles actually being something that improves the business. And that's especially true when you consider that these rides are cheaper to deliver because there's no human labor involved. Uber's CEO has said that autonomous vehicles might represent 10 to 15% of the mobility market down the road, and then continue to scale from there into the horizon. And as such, he imagines that Uber may initially need to invest in directly owning some of these vehicles, but eventually, and I thought this was quite interesting, he believes there will be financial companies that will arise, similar to REITs for hotels and office buildings, but instead for fleets of autonomous vehicles that will be run as businesses through Uber. It's sort of similar to how Marriott operates hotels, but doesn't own the real estate. All the real estate is owned by a real estate investment trust, or a REIT, aka, that collects rent from Marriott. And that's the idea here. You might have fleets of self-driving cars owned by financial companies who take on the asset on their balance sheet, whereas Uber operates the cars from a business sense by leveraging them in their ride-sharing network. And it's a pretty cool idea, honestly. And once again, the approach with self-driving cars is similar to what they've done with Didi and Grab. At first, they tried to compete directly with an autonomous vehicle team inside of Uber. And then when they realized how costly it would be to do so, they opted to simply invest in their competitors. In 2020, Uber got out of the self-driving vehicle business by selling those operations to a company called Aurora, and in exchange received a 25% stake in them. And I didn't know anything about Aurora, and I don't really know much about them now, but I'm sure it's a promising company for a few reasons if Uber chose them. And after I looked them up, I was kind of fascinated to learn they are a publicly traded company, and it was founded by the former chief technology officer at Waymo, as well as the former head of Tesla's autopilot team. So there you go. That pretty much explains why they're keen to partner with Aurora.
The powerful thing about Uber's approach to this is that they keep their business model asset light, and at the same time, they manage to stay at the center of all these developments that you mentioned. And that's strengthening their own market position. Nevertheless, this is a bit of a bet on the future. Part of the present is the $7 billion share repurchase program that they just recently announced. As a company that, as we have discussed today, seems to have endless reinvestment opportunities, is a stock repurchase program actually the right way to go?
The share repurchase program was announced last year, as you say, and it hasn't been without controversy. And presumably, it exists to offset the company's massive stock-based compensation costs, which have been very dilutive. Yet it raises the question of whether the cash should be used to repurchase shares, or if it'd be better off just reinvesting in growing the business, while also kind of highlighting the ugly reality of their stock-based compensation over the years, and how even though it's treated as a non-cash expense, it is a very real expense for the owners of the business. And after being criticized in an FT column, Uber CEO wrote back in defense of the program. So I'd like to just take a moment to read part of his response here. He says, quote, "I believe Uber's best days are ahead. We have a large utility-like business that is still in the early days of penetrating its market. This has led us to conclude that a consistent buyback program is the right answer for Uber. We are taking the humble investment route of dollar cost averaging over what we hope will be multiple years. Of course, this does not preclude us from taking a more aggressive stance on capital returns if our stock were to dislocate in the coming years. It is also worth emphasizing that the value creation from a buyback program doesn't happen in 1, 2, or even 3 years, but by doing so in a systematic and predictable manner as we continue to scale profitably." And he continues by saying, "As Uber CEO, I have to bet that my engineering pod can not only return 20% plus next year, but also earn a similar 20% plus each and every year afterwards. Ship one great project, identify another, ship again, rinse, and repeat. If my engineering pod fails to return its cost of capital, I can't sell it. I have to lay them off. He adds, on top of that again, just to keep reading here, quote, that comes with a financial cost, but more importantly, a human and organizational cost. It has been my experience that providing a stable, challenging, but consistent work environment is hugely beneficial to our team. They can be focused on work rather than networking for their next job in case there is a layoff. While many other tech companies overhired during the pandemic and had to subsequently fire many of those same employees, we have been disciplined about our growth and focused on building great products versus endless restructuring. So that was a lot to read. I'm sorry for putting you through it. That's all pretty interesting. But the counter response is that since Uber's CEO has more than $100 million worth of stock options that vested when the company hit $120 billion valuation, and for context, it's around $150 billion today, he was arguably, just maybe, trying to juice the stock with buybacks, even if done at elevated prices that destroy intrinsic value, just so to ensure his own compensation package comes through. And that is a very, very pessimistic way to look at things. But as investors, we do have to be pessimistic sometimes. And it's a fair point. If you follow the incentives, that is exactly what he's incentivized to do, to push up the stock price, irregardless of what is best for long-term intrinsic value. And that is the problem generally with incentive plans tied to market cap, as it is for Uber's CEO, and not total returns for shareholders.
Now, you've given a great introduction into the management team already. And one thing that almost every high-tech company, especially coming from Silicon Valley, has in common is a visionary founder. Now, Uber's founder has left the company many, many years ago already. So what do you think about the current CEO, despite what you already told us?
His name is a little bit of a doozy to pronounce, so I won't keep repeating it more than just once. And that's probably why we've been sidestepping saying it a little bit. But yes, Uber's CEO is Dara Khosrowshahi, and he replaced Uber's co-founder Travis Kalanick in 2017 after Kalanick became ensnared in a string of scandals, including allegations that he was turning a blind eye to workplace sexual harassment. And so Khosrowshahi is paid well because he's seen as this exceptional talent after having spent 12 years running Expedia, and he's definitely done some excellent things to turn the company around. I know that Bill Ackman, for example, has said Uber has an industry-leading management team that has done a lot to improve the operational discipline and capital allocation at the company. So that's a great endorsement to get. I've been really impressed in particular by how Uber's management has been able to leverage its two apps, Uber Eats and the regular Uber app, to cross-sell each other's services and all around boost customer loyalty and engagement. Since 2021, the number of monthly users who use more than one Uber product has risen from 21% to over 34%, which is even better than it sounds because they found out that folks who use multiple services from Uber end up spending over 3 times more than single product Uber users. And that's extremely compelling the first time I heard that, and it's still compelling to me, and shows just how sticky and valuable their services are for people once they branch away from just using Uber for ride hailing or only using it for Uber Eats. And related to that, they've also found that it's just much cheaper to acquire customers who use other Uber services than it is to try and market to people who don't use Uber for anything. So, for example, they can use the main Uber app as a tool to prompt people to download Uber Eats to take advantage of certain promotions, or they can use the Uber Eats app to encourage people to download the Uber ride-hailing app. And according to their investor update presentations, which are littered with some really great charts and visuals, the cost of acquiring customers from their own cross promotions is actually 50% cheaper than their acquisition costs from traditional forms of sponsored marketing. And as a further testament to these synergies, management has said that about a third of their delivery orders come originally from the main Uber app, and about a fifth of their ride requests come from people using the Uber Eats app. I think for the most part, Uber's leadership is focused on the right things and finding ways to get more out of every single person who interacts with one or more of their services. For a while, people thought Uber might become a super app similar to the super apps that have become popular in China that allow you to do almost everything you could imagine in one place. But clearly, Uber is taking an approach with multiple apps, including an app specifically for drivers too, and that's been working well for them. It's not as ambitious as building an everything app, but it's certainly more practical.
We've spent quite some time now talking about how Uber is operating in many different industries, and it seems there are even more options in the future. And then you have all the investments in ride sharing companies around the world. How about we try to tie all of this together to value Uber and you show us what you have come up with?
Where to begin? I'll try to tie it all together, and that is the question as always. At the top, I'll highlight that I try to build basic models based on management's guidance. And then I put checks in place if I think their projections are very clearly too optimistic, or I keep them in place if I think they're plausible. And with Uber, you've got some very positive projections going forward. Management has said they're targeting 30% annual earnings per share growth for the next few years, driven by mid to high teens revenue growth, margin expansion, probably from advertising, and then share repurchases. And I believe them. As we've outlined here today, I certainly can very plausibly see how that will all happen. And that is some serious growth for a company that is really not that richly valued, which means Wall Street either doesn't buy into that picture or think some really bad things can happen to Uber down the road in terms of maybe being displaced by autonomous vehicles. But with the company now comfortably earning over $2 billion a year in operating profits, while having $7 billion in cash on its balance sheet and no net debt, Uber is a very safe bet from a financial risk perspective. This is not a company that is going bankrupt anytime soon. That is maybe obvious to say to some people, but it's important to have said that as sort of a sanity check. There is some significant stock-based compensation, as we talked about, and that's a big problem. And I try to understand what their true earnings are. And typically people look at free cash flows to do that. And this is often calculated as just operating cash flow minus capital expenditures. I took it one step further, though, to also net out stock-based compensation, because that is a real cost that will either need to be reflected in shareholder dilution or in modeling out how many shares they'll have to repurchase to offset that dilution. So for the sake of simplicity, I want to just directly account for that dilution in my free cash flow numbers for Uber. And using these figures, I actually get an estimate that Uber earned $5 billion in free cash flow last year, which was negative as recently as 2022 and is up from $1.4 billion in 2023. So not to get too technical here, I don't want to drag people through the weeds of my model, and I'm not doing anything super fancy, but that is the approach, or at least the approach I used initially. And as I look at it, it's immediately clear to me that Uber is not richly priced, as I've said. It's trading at roughly 30 times last year's adjusted free cash flow, which is very reasonable for a business with the growth prospects that Uber has. Another thing to know about Uber too is that since the business was unprofitable for so many years, they have billions of dollars of accumulated losses that they can carry forward to offset future tax bills, which on the margins helps to pad out things and just provides one more reason to me, on top of many, to be optimistic about the amount of free cash flow Uber can generate in the next few years if they're going to have a relatively lower tax bill.
Throughout today's episode, you mentioned the similarities between Uber and Airbnb in terms of their platform model approach and also the regulatory risk that both companies definitely have or face. And I know you put together a similar model for the Airbnb episode recently. So how was that constructed? And are there more similarities or differences to the Uber model?
I took a slightly different approach in the model to focus only on operating profits as opposed to free cash flows, as we just talked about. Because Uber has a lot of cross holdings and tax benefits that make its net income and even reported operating cash flow a bit messy. So my premise is pretty straightforward. Estimate how gross booking values for the mobility and delivery businesses can grow over 5 years. Estimate the company's take rate by 2029, which again, I'll just say for the audience, is the percentage of gross bookings that they could capture as revenue from fees. And then estimate what the company's operating margin could be. Or another way to say that is their operating profitability. And there's a lot of digging into past financial results to look at trends in user growth and take rates and operating margins and so on. And I'll spare you from all that. And I should add that I focus only on the core business, which include mobility and delivery, and I left out Uber Freight since it's not popular and is also pretty small comparatively, but I'll get back to that in a moment and explain how I accounted for that in the valuation. With a very rough estimate of Uber's 2029 operating profits in hand, after I've done all that modeling I just kind of discussed, I can then try and estimate a range of multiples the stock might sell for in 5 years after its growth has started to maybe slow a bit. And then I can discount that 5-year value to a present value to determine what is roughly a fair price to pay for the stock today. And on top of that, I also added in the $8.5 billion of investments that the company carries on its balance sheet for owning stakes in some of its competitors like DiDi and Grab. And then I just generically tack on a 15% margin of safety to protect myself from any overly optimistic assumptions in the model and give myself a little room for error. And yes, I should also mention that because I stripped out Uber Freight from my calculations, I added the unit in at the end with a $3 billion valuation, sort of treating it as a wholly owned subsidiary that they might sell off eventually. Since there were some serious talks a year or two ago about spinning off the Uber Freight division at around that valuation I mentioned.
Perhaps it makes sense adding some context just to that topic. While a spin-off can be a great way to kind of set free value for shareholders, it is important to do it in the right environment when valuations are high. The freight business, however, saw some headwinds when the spin-off was discussed. The demand was weak and freight bookings declined. In that environment, you might not get the valuation you think the business would deserve, and then you just choose not to continue with the IPO. And that's basically what Uber did. Maybe that's just some context that helps folks listening to this understanding why you added back at the end and they didn't yet spin it off.
Yeah, I appreciate you saying that. And again, this is not rocket science. It's all very subjective. To just go back to my model though, to me, a 15% margin of safety makes sense. But for you, maybe it's only 10%, or maybe it's 20%, or maybe no margin of safety could make you feel comfortable with the uncertainties that Uber faces. The really important thing is just to not get crazy with the exit multiple, which is the valuation you anticipate the stock could trade at whenever you're ready to sell out. And for me, I say about 5 years generally. I base my range of multiples on, firstly, Uber's valuation ratios declining as the company matures and growth begins to taper off. And secondly, looking at some other big tech platform companies like Amazon, Alphabet, and Airbnb, just to see what's reasonable. Uber's enterprise valuation is around 55 times its operating profits, which is high compared to Airbnb, which trades at around 28 times operating profits, and Alphabet, which trades at below 20 times operating profits. Meanwhile, Amazon trades at over 30 times operating profits. But Uber arguably has the best prospects for further improving profitability and growth among any of those companies. So I have no idea if Uber's valuation will be closer to Alphabet's, Airbnb's, Amazon's, or at another level entirely in 5 years, but I'm pretty certain it will decline. And then I look at these other comps and decide a range of multiples that seem plausible to me, and I factor that into a weighted average value for the company. Not to keep forcing everybody to listen to a conversation about my model, but that is the idea, very simply, for how I approach things.
And I think it's perfectly fine going into some of the details because it's necessary to explain where you come from, right? But having said that, tell us, what's your intrinsic value target? I think we deserve to know now.
Yeah, to give you one number that contains a lot of assumptions in it, I get $75 as a fairly conservative intrinsic value target. And that doesn't account for the interest they earn on float, which is something I've covered with Airbnb, but they get paid up front and get to earn interest on that money before they have to pay it out. And they usually don't have as much float working in their favor as Airbnb, but it's still something to consider. It also doesn't account for much room for growth in the investments that Uber has in its competitors, but that is always possible. It also doesn't even really reflect the fact that they've relied heavily on promotions and discounts to secure market share in certain places. But as their position becomes more solidified, they can rely on those kinds of things less, which will just be very, very good for profitability structurally. And it doesn't anticipate that they can begin to reduce the share count as they get more aggressive about share repurchases either. I think that is possible, but with all these stock-based compensation they do, it'll just take a lot of repurchases over the next few years, which again, they're probably more than capable of doing. And it's just a question of how much stock-based comp increases and how willing they are to consistently do buybacks. Listeners can, of course, see my model and download it to play with for themselves by signing up for our free Intrinsic Value newsletter. As I said, though, I've probably been pretty conservative considering Uber's track record of growth, all the opportunities still available to it, and really just the advantage of Uber's scale and network effects generally. So I'm pretty excited if we could get Uber at or below $75 per share. I think we'd be taking some risks, namely with autonomous vehicles, but I just love these big tech platform companies. I love Spotify, I love Airbnb, and I really like Reddit. I just find their business models to be so promising. And if you can snap them up at a half decent valuation, then it makes a ton of sense to me. And Uber is definitely trading at a fairly attractive valuation. So that's how I'm thinking about it with Uber. I'm inclined to allocate a small position in the portfolio to them, maybe 2 to 3% or more, depending on how you see it, Daniel.
Well, there are companies where I do not have a problem with not being a customer. Just recently, we talked about Montclair, and I would invest in Montclair without being an owner of 10 Montclair jackets that hang in my closet. Now, with these platform business models, I like to have the perception of a customer as well. So I'm a user of Spotify. There's probably no app that I use more often than Spotify. I've booked 90% of my vacations or trips in the last years with Airbnb. With Uber, I do not have the same experience. Uber in the US, like we mentioned today, is totally different from Uber in Germany. And lacking the customer background makes it a bit harder for me to assess the investment case than it is for you. But Uber has proved that it can be profitable. It has proven to stay on top of competition, and it seems well positioned to benefit from a lot of those future trends that you have lined out today. So combined with a reasonable valuation, which it seems to have as well, I think it can be a good addition to our intrinsic value portfolio, though I would be in favor of a 2 to 3% position rather than, say, 5% or more. But I think we're aligned on that, right?
Yeah, it'll be a bit of a smaller stake than the bets we've made on Alphabet, where it's just a much, much more diversified business with a much better track record of operating profitably for a pretty long period of time. So, of course, I feel better about getting Google at a fair price and adding it to the portfolio at a higher weighting than I probably do with Uber, where there are still some major overhangs. And especially, like you said, it's harder for you to relate to what the company does and its value add. So I feel really good. I think a 2 to 3% position makes a lot of sense. It'll be technically our smallest holding, but it's still a decent sized stake in a company, especially as we're trying to build a portfolio of around 20 names. And we'll probably build conviction in it over time too. You might get more comfortable with it. I might get more comfortable with it, and we could increase that position. Or the opposite could happen. And we could find ourselves realizing that there's some other risks that we haven't accounted for. There's a change in the regulatory environment. There's a change in the technology with autonomous vehicles and our expectations around their adoption. Whatever it is, 2 to 3% feels like a pretty good way to frame things so that we have some exposure to the upside, but we're not going all in on a company that has some very big uncertainties lingering over its head.
The great thing about having these deep dives is that we now know the business on a level where we know what to look out for. So in a couple of quarters, or maybe even in a couple of years, we know exactly what to look for. And if, for example, the advertisement business is growing much further and much faster than it is currently, and it becomes a substantial part of the business, I myself would have a lot more conviction in the Uber business. And it's the same for other ventures that they are on. So I think building a small position of 2 to 3% is perfect from the start. And as you mentioned, seeing how Uber is developing can make the stake either grow in the future or even decline. But I think we're both pretty bullish right now. Otherwise, we wouldn't start this position at all.
Well, there you have it, folks. That's all we've got on Uber this week. And we'll be back again next week when Daniel will pitch me on his idea for an addition to the portfolio, and I will play interviewer. We'll sort of switch roles. As always, I will leave you with a quote. The legendary investor Phil Fisher tells us that if you are in the right companies, the potential rise could be so enormous that everything else is secondary. I hope Uber can be one of those companies for us, even if we only have a small stake in them. And there's certainly enough room for enormous growth still. With that, we'll see you all again next week.
Nike's mode is based on its marketing success through collaborations with the biggest sports athletes in the world, for example, Michael Jordan, but the resulting brand awareness wasn't its only mode. As mentioned, Nike's wholesale dominance was crucial as well, but perhaps That's not an actual mode. It's more of a legacy position that kept working because wholesalers had no incentive to cut the relationship. Unfortunately for Nike, they underestimated their own legacy advantage and they cut it themselves. Perhaps without having the most innovative products, the actual brand value of Nike is less important than one would have thought.